Yeah, absolutely. I am Dylan Lean. I'm a senior tax manager in the Eide SALT group, and I have Jennifer Barajas with me, a tax manager in the SALT group as well. And we are happy to be here to be talking about SALT consideration for remote workers and virtual fundraising in a post-pandemic world. So with that, I would first like to, we'll touch you there. So first, just kind of going through the agenda, thought we would touch on just kind of some of the budget impacts that have happened in the pandemic, and then go through some of the kind of basics for sales tax and nonprofits from a income tax perspective and a sales tax perspective. And then we'll touch on some of the kind of the remote virtual kind of considerations that we're seeing when it comes to either Nexus, or if you have remote workers who are working in another state that you're not too familiar with. And then we'll have kind of a look ahead as to the things that we're kind of thinking about over the next year. So then first, just kind of jumping to the impacts of COVID on state budgets. So during the middle of the pandemic, there was really dire predictions from state budget perspectives. And I bring this up because oftentimes state budgets drive a lot of tax policy. So again, if a state's facing a big shortfall, they may look to increase taxes or increase compliance. But over the past 6 months, the projections have been getting better, in large part due to the economic recovery. Some of the stimulus dollars coming from the federal government has also played a pretty substantial role in that, but states still kind of vary depending on their taxing regime, the kind of taxes that they're reliant on. If they're reliant on sales tax, those projections were looking rather dark about a year ago because we were looking at consumption being down. But again, when it comes to sales tax, there has been a definite kind of closing of that gap, and almost to the point of being at where they projected to be pre-COVID. Again, when it comes to the stimulus dollars, the income taxes have been relatively stable. Property tax is kind of a weird one because residential property values are kind of going through the roof, but commercial property values are kind of all over the map. And so, we don't really know, and we won't know for a while, kind of the damage that has been done due to COVID until a year, 2 years from now. So again, it's kind of an ever evolving situation, but we're not expecting those huge gaps where states might try to impose huge new taxes on, the businesses or, to a limited extent, nonprofits in that state. So it's kind of an interesting thing to follow that I kind of like to start with. So let's kind of talk through just some of the kind of the basics when it comes to sales tax for nonprofits. Some people on this webcast might not have kind of considered sales tax if they're part of a nonprofit. And so I wanted to kind of outline some of the basics first, and then we can jump to, what it's going to look like in a virtual world and some of the multi-state considerations. So in working in this space, I have seen some people anyways that believe that because they're federally exempt for income tax purposes, that from state tax perspective, they don't have any obligation as well. But I would say that's directionally correct in the fact that there are a lot of exemptions out there for nonprofits, but states do differ and the rules can differ from state to state. Also, again, from a sales tax perspective, states treat sales to a nonprofit very differently than they treat sales from a nonprofit, with the exemption for sales to a nonprofit being much more broad. But I'll cover kind of both pieces of that, both sides of that coin in the next slides here. So kind of jumping to sales to a nonprofit or purchases by a nonprofit, I generally put them into 3 buckets, and based on the names, they're obviously kind of unscientific classifications for each one of these buckets, broad, limited, very limited, but that's kind of, I haven't seen better terminology. So most states do have what I would call the broad exemption, which is they do respect the federal exemption for, say, a 501c3, but there are some limitations to that, in that if you have a nonprofit that's social in nature, like a softball organization, or it's non-charitable, like a homeowners association, the exemption might not apply. But typically, your organizations that are set up for charitable or educational reasons can get their purchases exempt from sales tax. And then fewer states, but maybe roughly 10 have what I would call a limited exemption, where basically the nonprofits that do qualify for exemption are either listed in statute or are listed on the Department of Revenue's website. So there's a level of kind of pre-approval that needs to occur before you can actually be an exempt nonprofit for sales tax purposes. And then there's a couple states that have a very, very limited exemption, being that it's only a couple organizations and it's only a couple kind of uses for that organization. And in those states, even their state and local governments oftentimes aren't exempt from sales and use tax. So again, each state kind of differs. This might sound a little redundant, but I will say that, again, if you're used to one state, don't just assume that those rules apply in another state that you're maybe moving to or doing more fundraising activities in. So as I mentioned, the purchases by nonprofits can be typically quite broad, as long as you're using those items in your organization for the stated purpose, you're likely to get those tax exempt. But when it comes from sales made by a nonprofit organization, this is where it gets a little tricky for a couple of reasons. So first, states look at sales tax as a tax on the end buyer, the end user, essentially. So if you're a nonprofit and you are making a sale, the sales tax isn't on you. You are just a collection agent of the state, and the tax is imposed on the end buyer. So for example, if I go to a raffle and I buy an autographed baseball or something like that, the tax is actually imposed on me, but you as the nonprofit is just an agent of the state remitting it to the tax. And so they do see that differently, as it's not really a direct tax on a nonprofit. But that said, they do understand that nonprofits there's still kind of a cost for compliance. And so they do try to find kind of a good median ground as to requirements when it comes to collection of sales tax from nonprofits. And then also too, states have some concerns with certain nonprofits competing directly with for-profit businesses. And so with this in mind, there's a pretty common rule that I've seen where states look to the number of days that you actually have fundraising events or are making sales, and they give you a certain number of days in which you can make sales, and those sales are not subject to sales tax, where you don't have to collect the sales tax. So in my home state, for example, they have like a 24-day rule that says, if you're kind of doing fundraising on an infrequent basis, 24 days or less, you don't have to collect sales tax on those sales in some instances. Ohio, that I have listed here, 6 days. West Virginia, I think, goes to the point of actually counting the hours of these events. Where you kind of run into an issue is if you do have some kind of selling activity that is constant and frequent, like say a brick and mortar store that's open every single day, or an online website that can be accessed 365 days a year. States might look to that as more of being in the business and selling and frequently kind of doing these activities, in which case it's more likely that you would have a sales tax collection. And so I'll just kind of mention again, if you're looking for a large fundraising event coming up here, do your homework. You can obviously reach out to someone at Eide Bailey, and happy to help and answer some questions. But I've often found that if you just you can just Google search sales tax nonprofits, Georgia Department of Revenue, and most states do usually have kind of a nifty 1 or 2 pager, basically outlining, here are the things you can buy exempt, here are the things that you can sell exempt. And again, it's better to do that before the event starts, instead of doing it after the fact, in which case finding out that you might have had to collect sales tax on those sales. Donations, thought I would touch on this a little bit too. So typically a monetary donation, there isn't any sales tax ramifications for that. If I donate $100 to a nonprofit, you don't really have to do anything from a sales tax perspective. Where it can get a little tricky is if there are either items that are being sold that kind of appear to be more of a donation, or maybe people are donating tangible items to your nonprofit. So again, states have kind of different rules, but you know, Colorado has an interesting one that kind of says that if you have a raffle and you sell a you have a computer that has a retail price of say $700, but someone spends $1,000 or $2,000 because they're donating as part of that, you know, that kind of raffle, that you can kind of exclude that excess over the kind of the listed retail price. And again, it's just something to kind of be aware of, because you wouldn't, if you have a, you know, $7 laptop, but someone's feeling they want to donate $5,000, they have to collect tax on that overall $5,000. So just kind of be aware there are those exclusions. Another thing in Minnesota I bring up, and it's also common in a lot of states, that businesses that do donate tangible personal property to a nonprofit, the business itself might have a use tax obligation. So not the nonprofit, but the business. So I'll give you a live example that I actually saw when I was an auditor for the state of Minnesota, which is lumberyard purchased lumber for resale, because again, they were planning on selling it. They don't end up selling it. They donate it to a nonprofit school. And the state of Minnesota says that that business should have accrued use tax, which is the mirror to sales tax, the self-assessed sales tax, for that, the cost of those materials that were donated, even if the school receiving it was a qualified nonprofit in the state. So it's something to just kind of be aware of. It won't apply to individuals donating items if they had paid the tax already. You know, think of if I purchased stuff again at Target, I paid the tax and then I later donated. There's no use tax obligation there. But if a business purchases something for resale, withdraws it from inventory, gives it to a nonprofit, they might have a use tax obligation. Also, something that comes up a lot is admissions. Admissions can be taxable depending on the type of admission. Generally think places of amusement that a for-profit business would be charging sales tax on, like a golf course is kind of a perfect example. If you do have admissions to those types of places, you just kind of want to be careful, check the rules, because again, you might have to collect tax on those admissions. You know, hopefully you would fall under some exemption for the 24-day rule or whatever it might be. But again, just kind of do your homework on those. I have here Louisiana, which has an interesting rule where you need to get pre-approval for some of these events. There's a recent taxpayer who had an appeal there, who didn't, file the proper paperwork 30 days in advance of some performance where the proceeds were going to be donated. So be aware of that. Granted, the pre-approval is pretty rare, but it does exist. And then I have an example here of California. Some states, there aren't any exemptions for the sale of food and prepared food. And so what California is saying is, if you kind of bundle everything together where you have a non-taxable admission, but you maybe have taxable food, you might have to collect tax on that overall charge to get into the events. And so in those instances, it would be wise to maybe attempt to break that out and say, okay, admission is $30, the food charge is $30, to maybe limit how much tax you would have to collect on those sales. So I'm not going to go through this chart. I just bring it up because it's fascinating. Minnesota has this decision flow chart as to figuring out whether or not your nonprofit sales should be tax exempt. I think there's like 11 or 12 different questions that you have to answer. So it can get fairly complex. But again, I don't really want to scare anybody when it comes to the takeaways, that there are a number of different exemptions out there for nonprofits. You just need to be aware of the rules in the states that you're operating in. And also just kind of planning goes a long way as well too. You can just kind of check some boxes just to make sure that you have everything kind of set up and ready to go and don't have to worry about sales tax. It's better to be proactive than reactive when it comes to that. And again, as I kind of mentioned, there is this real distinction between purchases made by an exempt organizations, typically more broad, versus sales where you can get a real specific fact pattern that needs to be addressed. So then I think that gives us a groundwork for the sales tax, kind of what you need to be thinking about. And then we'll go into some of the virtual considerations when you're doing fundraising online and in different states. And with that, I'll turn it over to Jennifer to address some of the income tax considerations for nonprofits.
Thanks, Dylan. Good morning. I'm Jennifer Barajas. I am a manager at Eide Bailey, and I have been working in state and local tax for about 10 years with a lot of experience in the income tax space. So while we don't typically think of income tax with nonprofits, there are some things I think are really important to mention. Trying to click, okay, here we go. Sorry about that. So when you think of your traditional nonprofit organization, typically are organized around a mission and a purpose. You should be very familiar with your organization's purpose because it's important when you start thinking about things like tax. For the most part, if a nonprofit is exempt from federal income tax, then all of the income that they generate while fundraising for their mission is going to be exempt from income tax, both federally and at the state level. Something to mention is that while you have a federal exemption, about half of the states will accept that exemption automatically. And then the other half of the states want one of two things. They either want a copy of your federal exemption before they consider you to be exempt at the state level, or they have their own specific application process to get your tax exempt status for income tax. Florida have their own special state tax exemption. So if you are operating in those states, or if you branch out into those states, you may need to get the state specific exemption. So for the most part, income tax is kind of after the fact. Most nonprofits aren't thinking about it because if their day-to-day operations are not subject to income tax. Something to point out though is if you're engaging in any type of fundraising activities that is considered unrelated business income, then you will have to file a special federal return and state return and claim that income and pay tax on it. There are certain types of nonprofits that will never have unrelated business income, and those are trusts with certain charitable foundations or corporations that are organized by the government. So they're not truly a governmental entity, they're a nonprofit, but they are funded by the federal government. Those types of organizations will never have unrelated business income. But since most nonprofits don't fall into one of those two buckets, we'll talk a little bit more about unrelated business income and what exactly that is. What is unrelated business income? Unfortunately, it's going to be a different answer for every organization. So for most organizations, in terms of looking at whether or not you have unrelated business income, it's something you're going to have to look at every year. And you need to look at your fundraising activities and see if you're doing anything different from the prior year. And with COVID, that's probably correct for most organizations, as a lot more things are happening online. Due to not being able to get together, people have changed the nature of their fundraising for in-person or virtual. So it's really important to look at your fundraising activities and see if you still meet the exempt test for that particular line of income, or if you need to look at it more closely. So the IRS definition of unrelated business income, and most states follow this, is an income from a trade or business regularly carried on that is not substantially related to the charitable, educational, or other purpose that is the basis of the organization's exemption. So what you presented to the IRS to originally get your exempt status is what they're going to look at in order to determine if everything you're doing is for purposes of that mission, or if you've deviated a little bit, which a lot of organizations do. The goal is to raise money, and there's many ways to raise money. So it's a three-pronged test. Trade or business means any activity conducted for the production of income from selling goods or performing services. Regularly carried on means frequent and continuous in nature, and you would look at a for-profit business to compare. Not substantially related means the activity does not contribute importantly to accomplishing the organization's purpose. Since that's about clear as mud, I do have some examples here we can talk about. And the IRS has a lot of information, more so than the states, for examples of unrelated business income. So it's going to be unique for every organization, but we'll just give some examples here to help wrap your mind around it. Rents received from the use of facilities. Some examples here would be your organization has a meeting space that you use for your own, members, and you lease out that meeting space for something like weddings or business conferences or parties. You really just, you leave it available for the general public, and that could give you a substantial amount of income each year. Well, if what the space is being used for is not directly related to your organization's mission, then the IRS and the states that you're operating in are going to consider that unrelated business income. Another example would be services provided with the rental, and a good example of that is security. So say you do have an event space, you're renting the event space, which could already be triggering UBI. And then if you have your own security team, you're providing to the group that's renting your facility, that security services income can also be considered UBI. Membership list sales would be if you are selling to like a for-profit organization, you have like your members' names, emails, or mailing addresses, and you make money from selling that. That's not directly related to your mission. The pet boarding and grooming one is interesting because the example given is for like an animal rescue organization. And I feel like you could take this same concept and apply it to a lot of different groups. So if an animal rescue organization's main mission is to have rescue animals and have them be adopted, then the boarding and grooming they provide to the animals they're hosting is not considered unrelated business income. But let's say they offer the general public boarding and grooming services, well, then that part of the income is going to be considered unrelated business income. Although it's in the pet space, it's not directly related to the rescue mission. It's considered a separate set of services, and that's going to be taxable. We don't have to go through every one of these, but magazine publishing I thought was an interesting one. So a lot of nonprofits have like a quarterly or monthly publication they send out to their members. That itself is not going to be considered unrelated business income because it's often given as part of their donations or membership. But if there's a magazine that you're putting together and you're selling it to the general public, more than likely that's going to be unrelated business income. I also have on here partnership income and loss, or S corporation income and loss, and we'll talk a little bit more about those. Okay, so first we'll talk about partnership income. A lot of nonprofits invest in other for-profit business entities through a partnership interest or through a limited liability company membership, which is very similar to a partnership. The IRS and the states allow certain items from the partnership to be considered not unrelated business income, and then there are certain items that are considered unrelated business income. So the tax preparer and the partnership that you may be invested in are actually supposed to give you that information. What I have on this slide is an example of a footnote that would be behind a federal Schedule K-1. And this is an example of what they're supposed to provide for you. And a good tax preparer would provide you the federal unrelated business income and the state unrelated business income. So not all 50 states have their own separate Schedule K-1. So more than likely, you're going to see this information in the federal footnote. And again, you have to look at the purpose of the investment. And if they're reporting to you items of unrelated business income, then you're actually going to have to file returns and report that, unfortunately. The main difference between a K-1 from a partnership or LLC versus getting a K-1 or pass-through income from an S-Corp is that the rules related to S-Corps are a little bit different. Unlike partnership where you go item by item to see if it's unrelated business income, the IRS considers all of the income and loss items from an S corp to be unrelated business income. So I put a picture on here to show you all these Schedule K1s look very similar. If you look in the top left of the form, it has Schedule K1 Form 1120S. That indicates that it's actually from an S corporation. So if you had a K1 from an investment and has this 1120S designation, then you need to treat all of the information as taxable, and you're going to have to report it as income. Now, here's the good news. The IRS and the states have agreed that while the items in this list are not related to your organization's purpose or mission, these items under a certain set of rules are exempt. So if you are engaging in these types of fundraising activities, there's a little bit of a test for each one that the IRS has definitions for, but you are allowed to do any of the things here, and that income is not considered taxable. So it's different from your mission or your purpose, but it's just specifically excluded. The IRS is trying to give organizations some ideas here. Like, here are some things you can do besides your ordinary operations, and you're allowed to fundraise here in this space, and you're not going to have to pay tax on it. So if you're looking to branch out and do some different things and not have a bunch of income tax headaches, you want to try to do things from this list. My favorite one are the conventions and trade shows and the public fairs. That might have changed a little bit with COVID-19 pandemic, but hopefully we'll have more of those going on in the future. Bingo is a very popular one. Gambling, aside from bingo, there's certain things that you have to do in order to meet the exemption, but it's an option. And I personally have seen a lot of nonprofits engage in that. You are allowed to receive certain sponsorships from businesses and individuals. And you are able to sell donated merchandise. So if you go out and you're buying items to resell, then you have to kind of individually test to see if selling those items meet your organization's mission. But if I donate a car to you and you resell the car, or you give it away as part of a fundraiser, then you're not going to have to pay income tax on that. So donations for products are the way to go if you don't want to have to run into UBI issues.
Perfect. So let's talk Nexus and state enforcement. So Nexus is kind of defined for tax purposes as a connection to a state. And with this connection, if you reach a certain threshold, that state can impose their taxes, a variety of tax obligations on your organization. And I bring this up because it comes to the virtual aspect of fundraising. You have an online website, and you're selling to a bunch of different states and different individuals in those states. Do you have an obligation if you're based in Minnesota and you're selling into Georgia or Texas or California? Well, it comes down to a couple different kind of components. So the first being, which has been historically the driver of creating Nexus in a state, is the physical presence test. So for most of you on this webcast, you probably recall a time where Amazon didn't charge you sales tax when you went online and bought something off of their website. Again, one time in the past, Amazon was, kind of relegated to Washington, and they didn't have a physical presence in your home state. Therefore, they didn't have to collect your state's sales tax when they sold you something that was clearly taxable. In Minnesota, for the longest time, they didn't collect sales tax until they put a distribution center in this state. Putting that distribution center in the state gave them physical presence, and therefore they had to collect sales tax on all of their sales that were shipped into this state. And physical presence typically takes the form of an office or employees or inventory in a state. And this can be kind of permanently in the state, or even temporarily, where you have an employee coming into the state on, kind of organization business, and they're here for 2 or 3 days, depending on what they're doing. That alone could create a physical presence nexus. And then it can get a little bit more complicated too, with if you have, sister organizations that are doing stuff on your behalf, they might fall into the definition of what could be considered an agent. And so physical presence can get a little murky, but usually it's, do you got someone in the state? Do you got an office in the state? Do you got inventory in the state? And this obviously goes to that kind of the virtual aspect of the pandemic, where you might have people working remotely in different states. Those individuals working in another state might give you physical presence nexus. And Jennifer will talk a little bit more on that in the next section. So again, physical presence was kind of the law of the land for the longest time. Well, what emerged in 2018 was this idea of economic nexus. Basically, if you were to get over a certain threshold of sales in a state and you have enough activity in a state, that state can impose a collection requirement on you as well. And this all comes from the landmark Wayfair case. So think of the online furniture retailer. So South Dakota, back in 2016 or 17, passed a economic nexus law, which they knew was unconstitutional based on current Supreme Court cases, Quill being probably the most recent relevant one in 1992, stating that you have to have physical presence. South Dakota passed this law anyways, knowing that hopefully it goes to the Supreme Court and the Supreme Court will rule in their favor, which they did in 2018. The Supreme Court said, South Dakota, your law it's good, it's valid. The world has changed since 1992. Therefore, you can impose your economic nexus law. And of course, all the states jumped on board after that. Over the past 3 years, states have been enacting economic nexus laws using South Dakota's law as a framework, which was 100,000 in sales or 200 individual transactions. So that's usually kind of the floor, the basement that states will set for you to trigger economic nexus. Some states will have some higher thresholds, $500,000 in like a Texas or California. Some states don't have that individual transaction count. And we have seen that states are more focused on revenue, but be aware that if your organization is making more than 100,000 in sales or has 200 individual transactions, they might have a collection you might have a collection requirement in that state. Now, again, you would then go to kind of those rules for nonprofits to see if, in fact, yeah, you might have nexus, but you still don't have a collection requirement because you're, hosting 12 events or something, and that's the rule in that particular state. So it's kind of a two-part test. Do you have nexus? If you don't have nexus, you don't have to worry about it. If you do have nexus, then you need to check that state's rules. And again, you got to look to the physical presence test and then the economic nexus test. And as of June 2021, all states with a sales tax have enacted economic nexus laws. Now I'm cheating a little bit because Missouri, the governor hasn't signed that bill yet, but he stated that he intends on signing it. So once he signs that bill, all the states with a sales tax will have imposed economic nexus. I would note that their start enforcement date has varied over the past 3 years because it takes some time to enact these laws. So your starting point of when you potentially could have had nexus will differ from state to state. Also, as part of this nexus concept, a lot of states adopted what are called marketplace facilitator laws, targeted towards the Amazons and the Ebays of the world. Basically, if you have an online marketplace, what states enacted was if you have third-party sellers, but you're collecting the funds and you're distributing it back to the third-party sellers, you have the obligation to collect the sales tax, not all the individual sellers on the platform. And it makes sense from a state's perspective to have Amazon or eBay collect those taxes versus having to audit tens of thousands of individual small sellers on a platform. So I just bring this up if you have a website that you might have third-party sellers on there, and you are collecting the funds on behalf and taking a cut and then giving it back to those sellers. that you could be deemed a marketplace. So it's not just the Amazons of the world. Smaller companies, smaller organizations have run afoul of this because, again, they just have a website where they're selling other people's items online.
Okay, so let's talk a little bit about what's going on with the members of your organization. And by members, I should say employees or contractors, people that work for the organization as part of the mission or purpose. There we go. So something that has happened with most workplaces, whether for-profit or nonprofit, is you have a lot of employees that may have relocated due to the pandemic. Offices were closed for a really long time. Some are still closed. And so you have employees that may be working from home. They might have moved to a different location and are still working for you. These situations can be, for temporary purposes, or they could be permanent moves. And so as an impact from that, you need to look at if you have employees that permanently or temporarily move to different locations, do you now have Nexus, which Dylan was talking about? And Nexus for sales tax a little more narrow, and Nexus for income tax a little broader. But what you most likely have Nexus for is payroll tax. So you need to be able to keep track of where your employees are and what's changed. And then you need to look into, the impact for each of those potentially new states that you're considered located in these new states, even if your headquarter operations are somewhere else. So it's still important to look at the individual state rules. So for Nexus, just having an employee in a new state, whether you have fundraising activities there or not, generally does create Nexus. So for sales tax, now you're on the radar. You need to look at your purchases to see if you have any use tax obligations. You need to look at your sales that Dylan talked about to see if you need to be collecting on any of your sales with customers in that state. And then it's just important to mention that there are some temporary COVID rules that states have adopted saying, if your employee is only in our state as a result of the pandemic, you're not required to withhold payroll taxes. You can treat it as though they were working from where they worked before. And also related to income tax, there's been some relief saying if your employee is here temporarily as a result of the pandemic, you're not required to file income tax returns. And that applies to, for-profit organizations or nonprofits that may have UBI issues. So in terms of the traveling employee, and by traveling these days, it might just be move for 3 months to a new location or move permanently. But the rules are different in all of the states in terms of payroll tax collection. So 24 states require you to register and withhold after the employee is there for 1 day, unless they have a temporary COVID relief policy. Other states have different rules where it's how many days or how much time, or if you paid them above a certain dollar amount, and that would be, ongoing. So if somebody was there, say 10 days, and they made over, I don't know, $1,000 payroll from you, then you have triggered a filing requirement. So there's really not a blanket rule for all the different states on the payroll tax collection, and you really kind of need to consult some advisors or look into, get a heat map of where everyone is, if anybody's moved, and then make sure that you're following your obligations in those states, because it's not like income or sales tax where you could have exemptions. Payroll tax is a little bit different.
Okay, lastly, I'll kind of tie this together as to, what we're looking at, going forward as we emerge from the pandemic. So the biggest thing is this growth in the Zoom economy, as to people working remotely, not only working for an organization remotely, but providing services remotely. And I think states are going to look to address these, the new economy with new regulations, new taxes, new rules, because it can get a little complicated as to how do you source services? If you are you're sitting in Minnesota providing a service to someone in Georgia or in Iowa, whatever it might be. And not only that, you do have instances where states may be fighting over the same revenue. You can see this in withholding tax, where one state says, well, the person worked in our state, you need to withhold our tax. Another state saying, yeah, but their office is in our state. We believe that you should have to pay our withholding tax. And so I see that as just kind of emerging, because this isn't going away. You will see more and more kind of just remote working. Even though a lot of us have been kind of coming back to the offices, I haven't heard of a lot of organizations that have gone back to 5 days a week. It's at least some kind of temporary, flexible arrangement. And then, as Jennifer mentioned, there were a lot of temporary COVID rules in place when it came to Nexus, or even forgiveness when it came to late filing of a return. We should see a return to normalcy, and maybe some of these temporary measures will and likely will expire, in which case, if you had someone working remotely, that temporary exemption expired, well, now you have an obligation. One thing that we've seen even prior to the pandemic is just a lot of locals trying to address their budget concerns by passing additional taxes. You're seeing it especially in the large metro areas like San Francisco, Seattle, Minneapolis to some extent, where you'll see like a bag fee in Minneapolis, or certain commercial rent fees, or whatever it might be. That, again, they found this as a kind of a great mechanism to generate more revenue, and also it can be targeted. Like in Seattle, there was this ongoing battle of taxes that were kind of specifically written for Amazon because they were such a large employer, and I don't think that's going to stop. And additionally, too, at least at the city level, it can be often easier for a city to get these taxes through, because it might just be, the board of the city that can kind of just write a one-pager and pass it, versus kind of the rigid expectations of getting something through a state legislature and signing of by the governor. And then kind of lastly, which has just been awful fascinating, is tax revenues being used as a political tool, where a state government might be fighting with a local government, and they might withhold some funds to try to make that local government do something that the state wants it to do. Again, we live in interesting times, and it's just fascinating to watch this unfold, where this tax revenue can be kind of a pawn or a ploy in political games, and that probably won't end either. But I think the biggest takeaway is this remote environment kind of takes off the box of maybe the state that you were working in and fundraising in. And although remote virtual fundraisers aren't new, they've been happening for a while, they had just kind of an increase in popularity. And in that increase, you just have to be careful as to, do you have obligations in the states where that person who's attending that virtual fundraiser or buying something, do you have to collect that state sales tax? Do you have an income tax obligation? If your employees are moving around the country, do you have to withhold that state's withholding tax? And so I think it's always good to kind of take a snapshot as to, where are your people located? Where are your offices located? Okay, do we need to do anything from an income tax perspective, from a sales tax perspective? Additionally, when it comes to new fundraising streams and new jurisdictions, new states, do a little legwork on the planning on the front end, because again, you'll be very happy that you did, versus doing a large event, finding out that you should have collected sales tax. States don't often do a lot of auditing of nonprofits. I was an auditor for the state of Minnesota for the longest time, and it wasn't top of our list to go out and audit these nonprofits, but still they do happen. And so you need to really have your ducks in a row for sure. And so I think that's kind of pulls everything together, and we did leave some time at the end for some questions. But first, the polling question. So polling question number 5. Do you feel that based on the presentation that your company is positioned properly regarding state and local taxes? Yes, we have everything covered. Yes, but with a few minor issues to address. No, we still face significant challenges. Well, that is good to hear. Again, it's quite daunting when, especially if you're operating in one state and then all of a sudden people are moving, you're doing virtual fundraising, and you have all these state obligations. Again, I've gotten a number of those calls, Jennifer, you probably had too, where it's like, what do we do? We've only been filing in Minnesota for the past 5 or 6 years, and someone says we need to look at other states.
Yeah. And state tax is an afterthought even for for-profit businesses. So
Yeah, most of the calls happen after the fact, where we've been operating and selling into multiple states for a number of years. What can we do about it? But again, it's better to make that call before you have that big fundraising event. And let's just, again, there's a lot of exemptions out there. You're likely covered, but just do the legwork on the front end and you'll be happy to do